Hi, my name is Jennifer Procel, and I am the VP of Tax and Accounting here at IOOGO Tax. And today I want to talk to everyone about tax considerations for crypto investors. And yes, your crypto is taxable. So let's get started on your crypto investments. So, your tax considerations for crypto investors. Yes, again, your crypto is taxable. In 2021, it was a big year for crypto, with many new investors buying in for the first time. More than half of current Bitcoin investors began investing in the last 12 months. According to recent studies, while values dropped in December, many investors still had sizable gains. The IRS has made it clear that they are watching with a yes or no question about virtual currency near the top of the first page of your tax return. For most people who buy and trade crypto within online exchanges, accounting for it in your tax return is relatively easy. But like most things related to digital currency, things can get a lot more complicated the more active you are. When to report your cryptocurrency trades on your tax return. So let's get into this when it needs to be reported. Cryptocurrency may be subject to capital gains when exchanged or sold at a profit. Swapping digital coins, cashing out for US dollars, or even making a purchase may be taxable events. The gain or loss is the difference between your purchase price, which is known as the basis, and the value when selling or exchanging. And your tax rates depend on the length of ownership. So if you are purchasing with crypto dollars, simply buying virtual currency with US dollars and keeping it within the exchange where you made the purchase or transferring it to your personal wallet does not mean you will owe taxes on it at the end of the year. So you purchased your cryptocurrency, you have not done anything special to that cryptocurrency, you have not created a taxable event yet. Trading cryptocurrency. This includes selling your crypto for US dollars, exchanging one cryptocurrency for another, for instance, buying Ethereum with Bitcoin, or paying for goods and services with crypto. That will create taxable events. So, whenever you sell the investment or exchange the investment for another investment, that is, when a taxable cryptocurrency event happens. Here are some examples of these events. So let's talk about these in a little bit more detail. Here's some examples of taxable crypto events. So if any of these are happening within your crypto exchange, then you need to be conscious of your taxable event. So selling cryptocurrency for fiat money, so for government money, selling cryptocurrency for government currency, USD, euros, etc. That is a taxable event. Trading cryptocurrency for other cryptocurrency, for example, trading Bitcoin for Ethereum, as we already talked about, that is another taxable event. It is an exchange of goods. Using cryptocurrency to buy a good or service, again, is a taxable event. And then buying, selling, or trading an NFT, another taxable event with your cryptocurrency. So on the opposite end of that, what are some examples of some non-taxable crypto events? So here are things that happen often in your crypto world that are not taxable events yet. And that is buying cryptocurrency with fiat currency. So buying your cryptocurrency at the initial event is not a taxable event. If you donate your cryptocurrency to a tax-exempt organization is also not a taxable event. Gifting cryptocurrency to anyone if the gift is no more than $15,000. This is a flat tax rule, whether you are gifting someone in US dollars or cryptocurrency. Anything over $15,000 or anything $15,000 and below is not a taxable event if you are gifting to somebody. If you transfer your cryptocurrency from one wallet that you own to another wallet that you own, again, not a taxable event. And then buying an NFT with the fiat currency, with the government currency, is not a taxable event. It does not become taxable until you buy or sell or trade that NFT. So what is the big picture? Digital assets that you buy, sell, mine, or use to pay for things can be taxable. Also, if your employer or client pays you in crypto, that payment is taxable income. You report your transactions in US dollars, which generally means converting the value of your cryptocurrency to dollars when you buy, sell, mine, or use it. So it's very important to understand how much the cryptocurrency was worth when you got it and what you got when you sold it or exchanged it. So let's talk about the tax rates. Capital gains tax rates, you're going to hear this a lot when discussing cryptocurrency. Because the IRS considers virtual currencies property, their taxable value is based on capital gains or losses. Basically, how much value your holdings gained or lost in a given period. The difference between the amount you spent when you bought or received the crypto, again, it's its cost basis, and the amount you earned for its sale is the capital gain or capital loss, which you'll report on your tax return. The amount of time you own the crypto plays a very large part as well. If you hold on to a unit of Bitcoin for more than a year, it will generally qualify as a long-term capital gain, which is subject to the more favorable capital gains tax rates. So that is the key time period. Hold on to your crypto for more than 1 year to be allowed to claim that as a capital gains tax rate. So let's take a look at some of these tax brackets so you can understand the difference. If you don't hold on to something longer than a year, to your Bitcoin or to your cryptocurrency longer than a year, it's going to be subject to your personal tax rates. So this depends on, it gets included with your other taxable income. And you can see here, depending on how much you make, determines your tax bracket. So the more you make, the higher your tax bracket, up to 37%. And again, this is for married filing jointly. You can have tax brackets from 10% all the way to 37%. It's a little bit higher for married filing jointly couples, but still the tax rates go up to 37% when you are looking at your ordinary income. So let's look at the long-term capital gains rates so you can see what the difference is. For single filers, the highest capital gains tax rate is 20%, and that only happens when you have $445,851 of taxable income. There's only 3 tax brackets, 0%, 15%, and 20%. So if your taxable income is less than $40,400 or $80,800 if you're married, your capital gains tax rate is 0%. So that's a pretty big deal. It's a big difference than your ordinary tax rates. This is the difference between holding your cryptocurrency for less than a year versus more than a year. So again, if you're married, you have a max tax bracket of 20% for your capital gains rates if you have $501,601 in taxable income. So let's talk about reporting crypto income. Some people receive virtual currency as payment for services. This is happening more and more often. This might mean receiving crypto as income instead of cash, earning Bitcoin by mining new coins, or receiving coins or tokens as a reward for certain activities, such as Coinbase's Earn Rewards program, for example. Regardless of how it's earned, you'll need to record the value of the crypto in US dollars when it's received and report that income on your tax return. Crypto received as payments is considered ordinary income, again, what we have just discussed, and will be taxed at your ordinary income tax rate. Remember, as we just discussed, your ordinary income tax rate could go all the way up to 37%. So it's important to understand which crypto is considered income and which crypto is considered capital gains. If you receive crypto as income, it does not matter how long you have held that, income is income, and it will be taxed at your ordinary tax rate. The fair market value you capture sticks to that coin as the cost basis, which is every taxpayer's responsibility to track. So if you go and buy something with crypto you've earned, you'll need to reconcile its cost basis with its value when you use it for goods or services. This is the biggest task of crypto traders, is understanding what that value is, that basis when they receive it, and then what is worth when you have traded it. Here are some mistakes to avoid during this tax season. If you don't report taxable crypto activity or provide incorrect information about your investments and face an IRS audit, you may incur interest, penalties, or even criminal charges, since it may be considered tax evasion or fraud. If you're not using the right tax partner, it is probably the most common mistake. Not many CPAs are experienced in dealing with crypto trading, much less their tax reporting obligations. The best thing you can do to simplify your crypto-related 2021 tax filing is to look for a great tax solutions partner with tracked experience in crypto. Our IOOGO crypto tax experts are ready to help you. We have been working with many crypto traders, many taxpayers who have earned crypto as income, and we have the tools and processes in place, and we are ready to help you with your crypto tax. Thank you so much for joining this webinar. My name is Jennifer Procel. Again, I am the VP of Tax and Accounting here at IOOGO, and let's talk about crypto. We'll answer your questions and help you deduct your business assets. Come join us online. Look at us at ioogo.com.